The biggest money in the stock market is rarely made when a business looks perfect. It is usually made when a great business looks awkward, expensive people have already left, and Wall Street is still too distracted by the short term to notice what the machine will likely look like 3, 5, or 10 years from now. That is where I want to begin. Because most people still think stock market success comes from finding a secret ticker nobody else has heard of. It comes from recognizing that the market is temporary by nature, and that temporary discomfort can create a very large gap between what a company is and what the market is willing to pay for it right now. That is the real story in this group of stocks. Not that they are exciting. Not that they are growth companies. Not that somebody on the internet called them buys. The deeper story is that each one of these businesses is in some version of an awkward phase. One is being judged too narrowly as a bank when it is trying to become a financial operating system. One is being punished because investors are frightened by artificial intelligence at the exact same moment. The company remains one of the strongest enterprise software businesses in the world. One is being treated like a beauty stock that had a great run, while the market is underestimating the power of repeat purchasing and the optionality inside a multi-brand platform. One is being priced as a troubled energy drink name while it may still be in the early innings of building a global beverage platform. That is the shared mother line. The market is not confused about bad companies. The market is confused about good companies in transition. That is where the opportunity usually hides. I have always believed that the stock market's most profitable mistakes are rarely an obvious garbage. Garbage eventually gets treated like garbage. The bigger fortunes are often made in businesses the market still does not know how to categorize properly. People keep looking at them through the wrong lens, the old lens, the too simple lens, the lens that made sense 2 years ago but does not fully fit anymore. That is what I see here. And that is why I find this set of companies much more interesting than a casual viewer might. On the surface, this is just another 4 stocks to buy. Now list, fine. But beneath that wrapper is a stronger and more useful idea. Each one of these names sits at a point where the market term noise while the longer-term machine may be getting stronger underneath it. That is where I want to live as an investor. Not where everything is already clean and admired, where the internals are improving faster than the public narrative. The first company is SoFi, and I think the deepest misunderstanding around SoFi is very simple. Most people still look at it like a bank, and that is too small. Now, I do not say that to be clever. It matters because category is one of the strongest forces in valuation. If the market sees you as a plain bank, it values you one way. If it sees you as a digital financial platform with multiple profit engines, a long runway of customer growth, and a much lighter physical footprint than traditional banking, it values you another way entirely. That gap is where the money can be made. The source file makes the operating progress very clear. Net interest income growth was strong. Non-interest income growth was strong. Loan platform fees were strong. Total revenue growth was strong. Net income growth was very strong. Earnings per share roughly doubled, and the member count keeps climbing fast enough that it is no longer respectable to think of this as some tiny niche player trying to survive. This is already a real scaled consumer finance platform, and the scale keeps building. That matters more than most people realize. Because scale is the bridge between good products and great businesses. A lot of people can build a good app. A lot of people can market a good. Very few can turn that into a growing financial ecosystem where banking, lending, investing, card products, crypto access, and cross-selling all begin living inside one expanding customer relationship. That is what SoFi is trying to become. And if management keeps executing, that matters far more than the market's current tendency to talk about it only in terms of loan risk or whether the next recession might hit. Of course, the recession risk matters. Of course, management quality matters. Of course, banking is dangerous if you get arrogant. But banking can also be very simple in the long run. Keep the customers, keep attracting new ones. Do not blow yourself up when the cycle turns ugly. If you do those things well for long enough, the institution becomes larger than people expected, while the market keeps underestimating what the customer relationship is worth. That is where I think SoFi is headed, if the execution remains strong. The key word is, if I am not romantic about this. A digital financial institution still faces the same old laws of gravity. Credit can go bad. Growth can get expensive. A recession can expose who was disciplined and who was not. That is why I care much more about Anthony Noto's discipline than I do about the stock's current excitement level. Great financial businesses are not built by charisma. They are built by surviving the ugly years without blowing up the good years that came before. But if SoFi continues to walk that line, the upside is easy to see. You do not need heroics to imagine it. You just need to understand that a company with millions of younger customers, growing brand awareness, rising product depth, and far less physical baggage than the old branch bank model can become something much more profitable than the market is currently paying for. That is why I like it. Not because it is riskless, because the category may still be too small for what it is becoming. Now, let us turn to ServiceNow, because ServiceNow represents a different but equally important kind of market mistake. The market often becomes afraid of a great business exactly when the great business is spending heavily to protect or expand its long-term dominance. This happens all the time in software. A company is growing beautifully. Margins are wonderful. Cash flow is wonderful. Customers stay forever. Switching costs are enormous. Then something changes. An acquisition spree, a new platform build-out, a technology shift. Artificial intelligence becomes the new obsession. Expenses rise near. Term earnings stop looking as beautiful. Suddenly the market gets nervous and starts asking whether the old software king is now vulnerable. Sometimes that fear is correct. Sometimes it creates the opportunity. I believe ServiceNow is in that second camp. The source is very clear that ServiceNow's core business remains incredibly strong. Revenue growth remains strong. Customer retention remains strong. The platform remains mission critical inside large enterprises. The business model remains the holy grail business model, recurring subscription revenue tied to workflows that become embedded in the daily functioning of the customer. That is a serious moat. And in enterprise software, embedded systems matter more than public fear cycles. Once a large company builds itself around a platform like that, ripping it out is expensive, disruptive, and politically painful inside the organization. That inertia is worth a fortune. That is why I still love this type of business. The awkwardness now is mostly about transition costs. Artificial intelligence has introduced uncertainty into how the market thinks about future seat pricing, future labor automation, and the long-term economics of workflow software. On top of that, the company has gone through acquisitions and integration efforts that distort the short-term relationship between revenue growth and earnings growth. So investors look at strong top-line performance and comparatively weak earnings expansion, and they do what investors always do in these moments. They overfocus on the next few quarters and underfocus on the long-term franchise. That is exactly how great software assets become mispriced for patient people. The source goes out of its way to explain the company in plain language. And I appreciated that because the simplicity of the business is part of the beauty. ServiceNow helps large companies organize work, automate repetitive processes, reduce confusion, and manage a large stack of internal operational tasks from one system. That is not glamorous. Good. Glamour is overrated. Useful enterprise software that becomes hard to replace is one of the best business models ever built. It creates recurring revenue, customer lock-in, pricing power, and long visibility. I trust those traits very deeply. That does not mean the stock cannot fall more in the short term. It means the business is still the kind of business I want to own if the market is letting me buy it, while everyone is busy worrying about whether artificial intelligence makes the future confusing. The future is always confusing while great businesses are being built. The important thing is whether the customer need remains real, whether the platform remains embedded, whether the switching cost remains high, and whether management is spending in ways that strengthen the machine rather than weaken it. If the answer to those questions stays positive, then what looks like an awkward phase can later look like a gift. That is how I think about ServiceNow right now. Not as a broken software company, as a great software company being priced through temporary confusion. Now let us talk about e.l.f. Beauty, because this is where a lot of traditional investors immediately reveal their blind spots. They hear beauty, they hear cosmetics, they hear skincare, and they assume the business must be softer, more trend-driven, or less durable than serious sectors. That is often a huge mistake. A strong beauty business is one of the most beautiful business models in the world, if it is built correctly. The reason is simple. The best beauty brands are not one-time purchases. They are habitual purchases. They live in repeat behavior. People do not buy a good cosmetic item or skincare product once and then never again. They come back, they replenish, they repurchase. If the brand is strong enough and the price point is accessible enough, you do not just have sales, you have a pattern. Patterns are where the money is. The source understands this very well. And that is why I take the e.l.f. story seriously. The core e.l.f. brand is not just cheap makeup, it is affordable, high-quality habit, forming beauty sold at a scale and price position that makes it hard to compete with cleanly. Add in the acquisition of Rhode, which may be one of the hottest beauty brands in the space. Add in Naturium, which gives the company a very serious skincare angle. Now you are no longer discussing one product company, you are discussing the skeleton of a multi-brand beauty platform. That changes the valuation conversation enormously, because once a company proves it can build, scale, and integrate multiple consumer brands inside a category with recurring demand, the optionality begins to matter almost as much as the current financials. The market often underprices optionality, because optionality sounds speculative until it starts becoming visible in the numbers. That is what I think is happening here. The source is almost gleeful in how it lays out the bull case, and behind the excitement there is something very reasonable. The business still has years of double-digit growth potential. Rhode gives it an unusually powerful short-term growth lever. Naturium continues to broaden the story. The core e.l.f. brand remains highly attractive because of its value proposition. And the valuation relative to that growth looks much lower than many fashionable growth names that have far less repeat purchasing power or far weaker brand attachment. That is the important point. This is not just about cosmetics. It is about owning a repeat purchase machine, while the market is still not fully pricing the machine. I have always liked consumption-based models when they are attached to real love from the customer, not shallow love, not fad love, durable repeat love. That is the kind of thing Coca-Cola, Pepsi, and other legendary consumer names were built on. Different category, same underlying principle, the customer comes back. And if the company can widen the basket of what that same customer buys over time, the economics become even better. That is why e.l.f. matters. Not because makeup is exciting, because the model can be. And if you can buy a company with a still large runway, a still reasonable valuation, and multiple internal growth levers, that is the sort of thing I will always take seriously. Now we come to Celsius. And Celsius may be the clearest example in the entire file of what I would call the next generation franchise before the market fully admits it. The beverage space has created some of the greatest stocks in history, not because drinks are sophisticated, because repeat human behavior is sophisticated enough for shareholders when the brand is strong, the distribution widens, and the product gets built into daily habit. That is why Coca-Cola mattered, that is why Pepsi mattered, that is why Monster mattered, and that is why Celsius matters now. The source makes the historical point beautifully. If you bought some of the great beverage names early enough, the wealth creation was absurd. Once those companies become enormous, you can still make money. Yes. But the truly life-changing asymmetry usually exists when the company is still in the phase where the market has not fully decided whether it is witnessing a durable brand franchise or just another temporary consumer growth story. That is where Celsius still is. The company already has more maturity than the average person realizes. Celsius is no longer some tiny niche can on a forgotten shelf. The Pepsi distribution relationship matters. The Rockstar acquisition matters. The Alani ownership matters. International expansion matters. And the current size of the business still suggests a long runway if execution stays strong. That is why I find the story so compelling. It is not just an energy drink company anymore. It is becoming a beverage platform with multiple brands, multiple routes to shelf, and potentially a much larger international future than the current market is fully capitalizing. And because the best beverage businesses have such beautiful repeat purchase economics, the scale can become very powerful once the distribution and brand loyalty line up properly. That is the part investors love to underestimate. They see cans. I see behavior. Behavior is what gets rich. The source is also correct that international is really the larger decade, long game. The United States can still provide plenty of growth. But if the products continue to travel, and if management executes, then the next level of the story is not just domestic shelf space. It is global shelf space. That is where beverage fortunes become something much larger than their current market cap suggests. Of course, the risks are real. Consumer taste shift. Competition never disappears. Execution can disappoint. Distribution partners can matter too much. But that is true of all great early-stage franchises. The right question is not whether risk exists. It is whether the runway is still large enough, the economics still attractive enough, and the market capitalization still small enough relative to the possible future that the risk-reward remains compelling. I think that is true here. That is why I would own it. Now, let us step back because the deeper value in this entire source is not the 4 stocks individually. It is the shared pattern. SoFi, ServiceNow, Elf, Celsius, different sectors, different business models, different kinds of investors drawn to them. Yet the same underlying opportunity exists in all 4. The market is letting you buy long-run growth machines while it is temporarily distracted by something too small. In SoFi, the distraction is whether a fast-growing financial platform can be seen as more than a bank and whether it can survive the next ugly cycle. In ServiceNow, the distraction is whether artificial intelligence and temporary cost distortion cloud the near term enough to make people forget what kind of software asset this really is. In Elf, the distraction is whether the market is underestimating how powerful a multi-brand repeat purchase beauty platform can become. In Celsius, the distraction is whether the business is still early enough to become the next great beverage franchise or whether too much of the easy money was already made. Those are different surface stories, but the deeper story is the same. Each business is in an awkward phase where the public sees noise, but the long-term machine may still be getting stronger. That is where I want to buy. Not because awkward phases are comfortable, because they are where valuation and future can drift furthest apart. I have always believed that the market's best gifts come wrapped in temporary confusion. The crowd loves clarity because clarity makes people feel intelligent. But clarity is expensive. By the time everything feels obvious, the price usually reflects the obviousness. You get paid for living with the part that still feels mixed. That is why I like these situations so much. They are not clean enough for the average person, which is exactly what can make them so attractive for the patient investor. That does not mean you should become reckless. It means you should understand what kind of edge you are really trying to build. You are not trying to predict the next $10 in any of these names. That is a child's game. You are trying to find situations where the next 3 to 5 years still matter much more than the next 3 to 5 weeks. That is adult investing. The source is very explicit about this when it keeps brushing aside the question of where the next few dollars in the stock might go. I agree. That does not mean short-term price is irrelevant. It means the short term is not where the thesis lives. The thesis lives in whether these businesses can keep compounding the things that matter. Customers, revenue, margins, brand strength, product depth, distribution, free cash flow, embeddedness. If those things keep moving the right way, the stock will usually take care of itself over time. Now, let me say something else because this is where people often hurt themselves. A great long-term thesis does not give you permission to ignore sizing. That is one lesson buried quietly inside the source that I respect. The presenter is excited, fine. But he also keeps coming back, even if in his own dramatic style, to the idea that no position should be allowed to destroy you if the low probability ugly outcome happens. That is important. You do not need to be timid, but you do need to be sane. A concentrated high conviction portfolio is one thing. A reckless portfolio is another. The difference is not optimism. It is whether you left yourself any room for being wrong. That is why I like owning several great awkward stories at once, rather than one worship story at the expense of everything else. Not because conviction is bad, because reality is humbling. This is also why I find the valuation work in the source useful, even when it becomes very bullish. What matters most to me is not whether the exact future target gets hit. What matters is the basic structure of the bull case, base case, and bear case. That is how you think clearly. What if growth remains strong? What if it normalizes? What if things disappoint materially? If the stock still looks decent under a sober bear case, that tells you something important. It means the market may already be pricing too much fear. If the bull and base cases both imply excellent return, that means the opportunity may not require perfection to work. That is what I always want. I do not need fantasy. I need mispricing. There is another deeper lesson here that I think matters especially for younger investors. The greatest fortunes are often built not by buying the most obvious giant, but by buying the next giant while it still looks awkward to the majority. That is why Monster made more money than Coca-Cola for some people. That is why Nvidia made more money than older established semiconductor names. That is why Palantir made more money than mature software behemoths for investors who got the timing and the patience right. The next giant always looks a little unreasonable before it looks inevitable. That is how inevitability works in markets. It begins as a minority opinion, then it becomes a fight, then it becomes consensus. then it becomes expensive. That is why I am willing to buy the awkward phase if the business underneath it deserves that faith. And that is what I believe this group of stocks represents. Not sure things, not free money, not lottery tickets. A set of businesses where the market may still be underestimating how large the eventual machine could become because it is too busy arguing about the current awkward chapter. That is good enough for me. If I had to reduce the whole thing to one sentence, I would say this: the biggest money in growth investing is usually made when you buy great businesses. The market is still temporarily categorizing too narrowly, too fearfully, or too simplistically to value correctly. That is the truth I trust. And once you understand it, you stop chasing perfection. You stop waiting for every headline to become clean. You stop demanding that the market make you feel comfortable before you act. Instead, you start asking a much better question: is the machine getting stronger while the narrative stays confused? If the answer is yes often enough, that is usually where the money is. And that is exactly why I would buy these kinds of businesses when the market still sees their awkward phase more clearly than their destination.